Welcome back to Griffonomics. It is Tuesday, February 10th, 2026.
Great to be here.
And today we are doing something a little bit different. Usually, we're up at that 30,000-foot view, looking at macro market trends, dissecting economic theory.
The big picture stuff.
The big picture, exactly.
Yeah.
But today we are zooming in. Way in on a single ticker. But I promise you, this isn't just about one stock chart. It's a ticker that tells a much larger, much more complex story about where the industrial base of the Western world is actually going.
It's a fantastic choice because it's a micro story with, like you said, massive macro implications. We're really talking about the plumbing of the future economy here.
Exactly. We are talking about Amentum, ticker symbol AMTM. Now, be honest with me. When you first hear that name, Amentum, it probably sounds like a generic shell company from a spy movie, right?
Or, I don't know, maybe a spell from Harry Potter. It has that vague sort of corporate futurism vibe to it.
It really does. But while the name might sound a bit generic, the reality is anything but. This is a massive industrial pivot story taking place in real time. And the core conflict we're digging into today is something called the shrink-to-grow strategy.
Which is always a fascinating, and I should add, a pretty risky maneuver for any company to pull off.
It sounds completely counterintuitive, doesn't it? In a market that is just obsessed with top-line growth, always get bigger, always be acquiring, make that line go up, and to the right, Amentum is intentionally shrinking its revenue top line.
Right. They're literally making less money on paper.
To grow their bottom line. It's wild.
The best analogy I've heard is it's the difference between a bodybuilder who's just bulky and an athlete who is lean and fast. Amentum is trying to cut weight to run a marathon, not a sprint.
And the track they're running on, well, it's paved with what we're calling the second nuclear renaissance and the commercialization of space.
Yeah.
And these aren't just, buzzwords on a slide deck today.
No, not at all. They are actual line items on a balance sheet.
That's the key. And that's precisely what makes this deep dive so interesting. We are not talking about some theoretical tech that might exist in 10 years.
No, we're talking about contracts that are signed, sealed, and delivering revenue right now. Or at least they're supposed to be.
Right. We'll get to that. So our mission today is to generate a really granular investigative report on Amentum. We're going to unpack how they're pivoting from being a company that moves boxes, commoditized logistics, to a high-tech engineering powerhouse.
And we've got a serious stack of sources to back this all up. We've got the Q1 fiscal year 2026 earnings transcripts, which, they just dropped this morning. This is fresh off the press.
Out of the press.
We have the 10Q filings, a bunch of press releases about their big partnerships with Rolls-Royce and the Space Force, and a few show-me story analyst reports that are, frankly, a little bit skeptical.
Skepticism is good. We like skepticism here. So let's unpack this. I think we need to start with the identity crisis. Or maybe it's more of an identity evolution.
That's a better word for it.
Because the Amentum of today isn't the Amentum of, say, 2 years ago.
Not at all. Not even close. If you looked at this company back in 2024, you'd see a very different beast. To really understand Amentum right now, here in February 2026, you absolutely have to look at the merger that created this current version of the company.
It's a bit of a Frankenstein's monster, isn't it?
Yeah.
Cobbled together from different parts.
In the best possible way, I'd argue. It was formed by spinning off the Critical Mission Solutions business, or CMS, from Jacobs Solutions.
And Jacobs is a massive engineering firm, for those who don't.
Huge. And they merged that spinoff with the legacy Amentum business.
So Jacobs had this high-tech, high-hazard government unit, this CMS thing, and they basically said, you know what, we don't want this anymore.
Right, and Amentum said, we'll take it.
Why? Why did Jacobs want out?
Well, Jacobs wanted to focus more on its core infrastructure and global consulting business. Amentum, on the other hand, wanted to move up the food chain. So they took the brainpower and the high-level engineering from Jacobs CMS and combined it with the massive defense logistics scale of the old Amentum.
Okay, so it wasn't just a merger for size.
No, it was a portfolio reshaping, a strategic move.
But this brings us right back to that shrink-to-grow concept. Because you can't just mash two giant companies together and hope for the best, right?
Yeah.
You have to trim the fat.
Exactly. And in this case, the fat was actually a pretty significant revenue-generating business. This is the first piece of the puzzle that really confuses people when they look at the top line. We're talking about the divestiture of a unit called Rapid Solutions.
Right. They sold this unit off to Lockheed Martin.
For a cool $360 million in cash.
Now, let me play devil's advocate here. Rapid Solutions was manufacturing ISR systems. That's intelligence, surveillance, and reconnaissance tools.
Spy gear, basically.
Yes, spy gear. That sounds like a great business to be in. Why on earth would you sell a unit that makes spy gear to Lockheed?
Because it involves making things. It's hardware, it's manufacturing. And when you manufacture hardware, you have to manage these incredibly complex supply chains. You're buying steel, copper, printed circuit boards. You have to warehouse inventory.
And if a machine breaks on the assembly line, that's your problem. Your capital is tied up.
Exactly. It is incredibly capital intensive. Amentum wants to be a pure play services provider.
Pure play. That's the key Wall Street term here.
It is. It means they want to focus on one specific thing. High-tech engineering services. They want to sell expertise, not boxes. When you sell services engineering, consulting, program management, your margins are generally way higher and your capital risk is lower.
So you're selling the brains, not the brawn.
That's the perfect way to put it. So they looked at Rapid Solutions and said, look, this is dragging down our overall margin profile because it's hardware-based. And they looked over at Lockheed Martin and said, hey, you guys love building hardware.
And Lockheed does. That's their entire bread and butter.
Of course. So Amentum sold the hardware arm to Lockheed, took that $360 million, and immediately decided to focus purely on the high-margin brain power.
So that's the first big piece that explains why their revenue looks a bit lower on the headline, which we will definitely get to. They literally sold a chunk of the company, about 1% of their annual revenue?
Roughly, yeah.
Just to get leaner.
Yes. And it's important to note where that money went. That $360 million didn't go to a big party or executive bonuses. It went straight to paying down debt from the merger. It's a classic efficiency move.
Okay, so let's break down what is actually left then. If they aren't building the widgets anymore, what exactly are they doing? It seems like they've split the new combined company into two main brains.
They have. You've got Digital Solutions, which they call DS, and Global Engineering Solutions, or GES.
Let's start with Digital Solutions. This is the shiny high-tech stuff, right?
This is the growth engine. This is where they want the future of the company to be. Digital Solutions is all about high-tech, data-driven outcomes. We're talking cybersecurity, space systems, intelligence analysis, AML.
And how's it performing?
In the first quarter of fiscal 26, which they just reported, this segment grew 4% to $1.34 billion.
Wow, that is a healthy chunk of change. Over $1 billion in a single quarter.
It is. And if you kind of normalize it for some of the noise in the numbers, contracts shifting around and things like that, it's actually growing a bit faster. This is the part of the business where they're competing head-to-head with the big tech-focused defense contractors like a Booz Allen Hamilton or an SAE. This is the future-proofing segment.
Okay, and then you have the other side of the house, Global Engineering Solutions.
GES, the heavy lifters.
This is the heavy lifting, quite literally. This segment deals with high-hazard operations. We're talking nuclear energy, modernizing massive platforms like aircraft carriers, and managing incredibly complex assets.
Yeah, this is the gritty, difficult stuff that very few companies can actually do.
Can you give me a concrete example of a GES project?
Absolutely. The MQ-9 Reaper drone. Amentum manages the sustainment for the entire fleet. They keep those drones flying. Or another one is nuclear waste cleanup, which we'll get into. This segment brought in about $1.9 billion in the quarter.
But hold on, looking at the transcript, that revenue was down, wasn't it?
It was. Reported revenue for GES was down 11%. But remember, this is where the divestiture of Rapid Solutions hit the books. This is where the shrink to grow actually happens. They are actively pivoting away from the lower margin logistics, what you called moving boxes.
Right. The analogy we used in prep was moving boxes versus moving radioactive sludge.
And that is essentially the trade-off they're making. Anyone with a truck and a warehouse can bid on a contract to move boxes. That is a commoditized business with razor-thin margins because the barrier to entry is super low.
But moving radioactive sludge.
But moving radioactive sludge. That requires licenses, PhDs, specialized robotics, and top-secret security clearances. The market, meaning the government, pays a much, much higher premium for someone who knows how to move that sludge safely.
So they are actively trading volume for value.
Exactly right.
Okay, so that's the new structure. But we have to address the elephant in the room. The numbers that just came out today, it's February 10th. These earnings are fresh. And honestly, if I'm a casual investor, just looking at the headlines on CNBC or Bloomberg, I might be a little freaked out.
It was a messy quarter on paper, I'll absolutely admit that. Complexity is the enemy of a clean stock chart, and this quarter was nothing but complex.
Messy is one word for it. Let's start with the top line. Revenue was $3.24 billion. That missed the consensus analyst estimate by $86 million. I mean, in this market, an $86 million miss usually means the stock gets hammered.
Usually, yes.
But the earnings per share, the EPS, was $1.54, and that actually beat estimates by 2 cents. So they made less revenue than Wall Street expected, but they somehow kept more of it as profit than expected. Explain that.
That is the shrink-to-grow thesis in action, but there's even more nuance here. We have to explain why the revenue dropped. Reported revenue fell 5.2% year over year, which looks bad, but management is screaming from the rooftops in this earnings call that their underlying growth is actually plus 3%.
Okay, stop right there. How do you get from negative 5% to positive 3%? That feels like some kind of creative accounting. Like saying, I didn't lose weight, I just redefined gravity.
It's not quite that abstract. It's what they call normalized accounting, which, to be fair, is pretty standard in a big transformation year like this. First, you have to add back the revenue they lost by selling Rapid Solutions. That revenue is gone, but it was gone on purpose.
You can't penalize them for executing their own strategy.
You can't. That's step one. Then you also have to account for the fact that they shifted some contracts into what are called unconsolidated joint ventures.
Unconsolidated joint ventures. We need to translate that into plain English.
Okay, let's use a simple analogy. Imagine you have a lemonade stand. You sell the lemonade, you keep all the money. That's your revenue. Now imagine you partner with a friend. You still make the lemonade, but the stand itself is in your friend's name. You agree to split the profit 50-50. You still get the cash profit, but you can't claim the total sales of the stand on your personal tax return as revenue.
Ah, I see. So the work is still happening, the profit is still flowing back to Amentum, but the revenue line item on their main spreadsheet looks smaller because of the partnership structure.
Exactly. The activity is there, the profit is there, but the top-line revenue metric is artificially suppressed by the accounting rules for JVs.
And there was a government shutdown impact in there too, right?
Always. There always is. When the government delays budgets, which happens constantly, as we know, contractors have to pause work, that's revenue that gets delayed, not lost. Once the budget finally passes, the work resumes. So you have to adjust for that delay too.
Okay, I can buy the revenue story. It's complicated, but it makes sense. But here's the number that really scared me when I opened the 10Q this morning. Free cash flow.
Ah, yes. The big red ink.
It was negative $142 million. In parentheses. For a company that claims to be focusing on margins and efficiency, burning through $142 million in cash in a single quarter looks really bad. Are they bleeding cash?
Short answer, no. This is a classic timing glitch. And honestly, this is one of those things where if you don't read the footnotes in the financial statements, you miss the reality entirely.
Okay, explain the glitch.
Two things happened in Q1 of fiscal year 26 that just conspired to ruin the cash flow statement. First, the payroll cycle.
You mean just the calendar?
Just the calendar. It's simple math. Every few years, based on how biweekly pay periods fall on the calendar, a company has to pay its employees one extra time in a quarter compared to the same quarter last year. It just happens.
So Q1 had one more payday than Q1 of last year.
Exactly. And for a company this big, that is a massive cash outflow, we're talking tens of millions of dollars, that has absolutely nothing to do with the health of the business. It's just the calendar turned out that way.
Okay, so that's a one-off. What was the second thing?
The second thing was the government holidays. The entire federal government basically closes up shop for the holidays in late December. That means nobody was at their desk at the Pentagon or the Department of Energy to process Amentum's invoices.
So it's the classic, the check is in the mail.
Literally. The work was done in Q1. The invoice was sent in Q1. But the government accountant was on holiday break. So the cash didn't arrive in Amentum's bank account before the quarter officially closed on the calendar.
So just to be clear, they did the work, they paid their employees an extra paycheck because of the calendar, but they didn't get the reimbursement check from Uncle Sam in time.
That is the perfect storm of timing. And we can verify this isn't just some corporate spin because management confirmed on the call that in the first week of Q2, literally just days after the quarter closed, their cash collections rebounded by $100 million.
So the check cleared a week late.
The check cleared a week late. It's a temporary liquidity dip, not a structural cash burn. But, and this is important, it does highlight a risk we should talk about later. When your only customer is the government, you are completely at the mercy of their vacation schedule.
That's a great point. That makes me feel better about the cash flow. But let's talk about the debt, because you mentioned the Jacobs merger left them with a bit of a credit card bill to pay off.
It did. You don't merge two massive companies like this without taking on some debt. Right now, their net leverage is at 3.4 times.
For our listeners who aren't CFOs, is 3.4 times high?
It's a bit elevated, yes. In this kind of interest rate environment, you generally want to be under 3.0, maybe even closer to 2.5. Amentum's own stated target is to get that number under 3.0 times by the end of this year.
And are they making any progress?
They are. In fact, Moody's, the big credit rating agency, just upgraded them to Bay 3.
That sounds like a droid from Star Wars, but I'm going to assume it's a good thing.
It is a very good thing. That upgrade is significant because of the fine print in their loan agreements. Getting that Bay 3 rating triggered an automatic interest rate reduction on their big term loan B.
Oh, wow.
They're now saving 25 basis points, 0.25%, on their interest payments just for being perceived as better, more reliable borrowers.
That saves millions of dollars over the life of the loan.
Absolutely. But here's the part I really love, and it speaks to incentives. We always ask, are the bosses aligned with the shareholders, or are they just trying to pump the stock price in the short term? You have to look at their executive compensation plan.
I saw this in the proxy statement. It's really interesting.
Right. Executive bonuses are 15% weighted explicitly toward net debt reduction. That means the CEO and the CFO do not get their full bonus at the end of the year unless they pay down that debt.
So they are personally motivated with their own money to make sure that $100 million check from the government clears and goes straight to the bank to pay off that loan.
Absolutely. They have skin in the game. When management's wallet is on the line, debt usually goes down pretty quickly. They aren't going to go on some big spending spree until that leverage ratio is fixed.
All right, so the financials are messy, but they seem explainable. We've done the veggies. Now let's get to the dessert. Let's talk about the actual work they're doing, because this is where this second nuclear renaissance idea really comes in.
And this, to me, is the biggest differentiator they have from their peers. Most defense contractors are just defense. They build missiles, they build tanks. Amentum has this massive nuclear tailwind that nobody else in their peer group really has at this scale.
And nuclear is a huge piece of their business. It's about $2 billion in annual revenue for them, which is something like 14% of the total. But the word renaissance implies it's coming back from the dead. Why now? Why nuclear?
Because the math has finally caught up with the politics. The world has finally realized you cannot hit net zero carbon goals without baseload nuclear power. Solar and wind are great, but they're intermittent. The sun doesn't always shine, the wind doesn't always blow.
And things like data centers for AI need power 24/7, 365.
They need constant, reliable power. Nuclear is always on. And Amentum has positioned itself perfectly to capitalize on this, particularly outside the United States.
That's a key distinction you made in the notes. International versus domestic. Why does it matter where the reactor is located?
Because in the U.S., government contracting is just a blood sport of litigation. You win a contract, and the company that lost immediately sues to stop you. It's called a bid protest. Right now, as we speak, Amentum has $2 billion in contract wins that are stuck in protest limbo.
$2 billion.
Yes, that is revenue that should be coming in the door, but it's frozen by lawyers.
That has to be incredibly frustrating for them.
It is. But in the UK and in Europe, that culture of protesting every single contract award doesn't really exist in the same way. When Amentum wins a nuclear contract in the UK, it converts to revenue almost immediately. There's no pause button, and they are winning big over there.
Okay, let's talk about the Rolls-Royce partnership, because when I hear Rolls-Royce, I think of fancy cars or maybe jet engines. I do not think of nuclear power.
You should start thinking of small modular reactors, or SMRs. This is the future of nuclear power.
Unpack SMRs for us. What are they?
Okay, so the old way of building a nuclear plant was what I'd call the cathedral model. You build a massive custom-designed power plant on site. It takes 10 or 15 years. It goes billions of dollars over budget. Just look at the Vauxhall plant in Georgia.
A total mess.
SMRs are the Model T assembly line approach. You build smaller, standardized reactors in a factory, you put them on the back of a truck, and you assemble them on site. It's modular. It's supposed to be cheaper, faster, and safer.
It's like building a car on an assembly line instead of building a custom house from scratch every single time.
That's the perfect analogy. And Amentum was just selected as the global program delivery partner for Rolls-Royce's SMR program.
That sounds absolutely huge.
It is massive. They're looking at deployments in the UK and the Czech Republic first. And Amentum isn't just, pouring the concrete. They're doing the engineering, the design support, the construction management. They are on the ground floor of this next-gen nuclear tech. If SMRs take off globally, Amentum is positioned to be the general contractor for the entire revolution.
And then there's the other side of the nuclear coin. If SMRs are the birth of new nuclear, then a place like Sellafield is the funeral of the old nuclear.
Sellafield. It's the largest and most complex nuclear site in Europe, located up in England. It's a legacy of the Cold War and the very early days of atomic energy. It is arguably one of the most complex, hazardous engineering challenges on planet Earth.
And I'm guessing very profitable to clean up.
Very profitable. Amentum just secured a massive share of a $1.4 billion framework contract there. That's nearly $2 billion US dollars.
What are they actually doing? You mentioned a radioactive vacuum in our pre-show notes, which sounds terrifying.
It's essentially that, yes. They are the pond retrieval's partner. There are these huge legacy outdoor storage ponds at Sellafield that are full of radioactive sludge and old fuel rods from decades ago. You can't send a person in there.
You'd be dead in seconds.
Instantly. So Amentum is using advanced robotics and something called the bulk sludge retrieval tool to basically suck up all this hazardous material and package it for safe, long-term storage.
That is the very definition of a high barrier to entry. I assume you can't just start up a company in your garage and start bidding on the radioactive sludge contract.
Exactly. That is the moat around this part of their business. You need decades of safety data, you need cleared personnel, you need specialized proprietary tech. Once you're in a place like Sellafield, you are likely there for decades. It's incredibly sticky revenue. They're not going to fire you next year because you're the only ones who know how the robots work.
And they're doing this in other places too. It's not just Sellafield.
No, it's a global business for them. They have a $730 million contract with EDF to extend the life of the existing UK nuclear stations. They have a $207 million contract in the Netherlands for a brand new nuclear build program, and they manage all of Canadian Nuclear Laboratories, which is a CAD $1.2 billion annual operation.
So while the U.S. market is bogged down fighting over lawsuits, Amentum is quietly rebuilding and cleaning up the entire nuclear infrastructure of Europe and Canada.
That's the second nuclear renaissance thesis in a nutshell. It's international, it's high-tech, and it's growing fast.
Okay, let's leave the radioactive ponds for a minute and look up, way up, to the space economy. This is the other huge pillar of their pivot.
And arguably the sexier one. Nuclear is necessary, but space is exciting.
Their quote from the management team that really stuck with me is that they see a 3x growth in Space Force launches over the next 5 years. 3 times the launches means 3 times the wear and tear on the ground and 3 times the logistics.
And that is exactly where Amentum sits in the ecosystem. They are not trying to be SpaceX or Blue Origin. They aren't building the rocket.
They're running the spaceport.
They're running the spaceport. The airport analogy for this is the best way to understand it.
I love it.
Think of SpaceX as, I don't know, United Airlines. They fly the planes, they own the vehicles. Amentum is running O'Hare or Heathrow Airport. They just won the Space Force range contract, or SFRC.
Which is an absolute monster of a contract.
It's a $4 billion ceiling, 10-year IDIQ contract.
IDIQ, that's government speak. We need to break that down for people.
It stands for indefinite delivery, indefinite quantity. It's basically a hunting license. The government says we have up to $4 billion to spend on this specific task over the next 10 years. Amentum doesn't get a check for $4 billion today, but they are the pre-approved sole source vendor to grab as much of that work as they can. It's like an exclusive menu where they are the only chef.
And this covers the big launch sites, Cape Canaveral.
Cape Canaveral, Vandenberg Air Force Base, Patrick Space Force Base. Their job is to modernize the range. The range is all the radar, the tracking systems, the safety systems, the physical ground infrastructure.
Why does the range need modernizing? I mean, can't they just use what they have from the Apollo era?
No, because the tempo is changing dramatically. In the old days, you'd launch a space shuttle maybe a few times a year. It was a massive planned event. Now, the Space Force and commercial partners like SpaceX want to be able to launch a rocket every few hours.
Oh, wow.
They want rapid launch. You can't do that with 1970s infrastructure. You need automated safety systems, much better radar, faster turnaround times on the pad. Amentum is the company that's been Artemis II. This is the big one. The mission that will send humans back around the moon. Amentum engineers are literally responsible for operating the crawler transporter.
I love the crawler. It's that massive tank-looking thing that carries the whole rocket stack out to the pad at like 1 mile per hour.
It's an absolute engineering marvel. It carries the weight of the entire SLS rocket, millions and millions of pounds. Amentum drives it. But more than that, they also support the Launch Control System software. That's the digital backbone of the firing room at Kennedy Space Center. So when you hear the countdown on TV, Amentum's code is running the final checks.
Okay, so we have nuclear, we have space infrastructure, but then this outer net thing. This sounded like pure sci-fi when I read the source material. The outer net.
This is their strategic move into commercial low Earth orbit, or LEO. They've partnered with a company called Rivada Space Networks.
Rivada. And they're building a new satellite constellation.
A constellation of 600 satellites. But here's the key differentiator. Most satellite networks, like Starlink for instance, beam data down to a ground station, which then sends it through fiber optic cables on Earth to get to its destination.
Right. Makes sense.
Rivada is building a mesh network that uses intersatellite laser links.
Lasers in space.
Lasers in space. The data literally jumps from satellite to satellite. It can go from pole to pole without ever touching the ground until it hits its final destination.
Why does that matter? Is it just for speed?
Speed is part of it, yes, because light travels faster in the vacuum of space than in glass fiber. But the real selling point is security. If the data never touches a ground station in a hostile country, it can't be intercepted or tampered with as easily. It's what they call a zero-trust network.
So if the U.S. military wants to send classified data from a submarine in the Arctic back to the Pentagon, they don't want it running through an undersea cable that someone could potentially tap.
Exactly. They want it to stay in space where it's secure. And Amentum's role here is to be the reseller and the systems integrator. They're going to the Pentagon and other government agencies and saying, you need ultra-secure, low-latency communications that don't rely on vulnerable undersea cables. We have the outer net.
That is a fascinating play. It's selling connectivity as a service, not just, fixing radios on the ground.
And that transitions perfectly to what they're trying to do across their entire digital segment. They are trying to move everything as a service.
Right, the whole critical digital infrastructure push. We saw a big contract with DISA, that's the Defense Information Systems Agency.
This is a $120 million contract for what they're calling compute as a service.
Which means what?
Historically, the government would buy a bunch of mainframes and servers, spend millions and millions on hardware, and then pay a contractor like Amentum to fix them when they broke. That's the old model. Right. This new model is just like the commercial cloud. It's like Amazon Web Services for the Pentagon. The government pays for the computing power they use, on demand. Amentum owns and manages all the hardware and software. The government just buys the output.
That has to be a much higher margin business for them.
Much higher. And it's scalable. If they can prove this model works with DISA, they can roll it out across the entire Department of Defense. It shifts the risk to Amentum, but it massively increases the profit potential.
We should also touch on the more traditional defense side quickly, because even with all this new, shiny tech, they still do the heavy lifting for the military. The MQ-9 Reaper, for example.
The Reaper, the absolute workhorse of the U.S. drone fleet. Amentum just won a new $995 million contract for sustainment and modernization. This is making sure the entire drone fleet stays in the air. It's classic logistics, but for a very high-tech platform.
And then there was a counter-threat finance contract. This one sounded like it was straight out of a Tom Clancy plot.
It's fascinating work. It's a $247 million contract. They are using AI and machine learning to track illicit financial networks around the globe. We're talking about the Counter-Narcotics and Global Threats Division. They're literally hunting drug cartels and terrorist financing networks using data science.
And again, notice the theme. They're moving from bodies in seats, just putting a guy in a chair to look at spreadsheets, to high-tech analysis using AI.
That is the theme that runs through everything. Every single contract we've discussed today, the Rolls-Royce SMRs, the Space Force range, the Rivada lasers, the AI financial tracking, it's all high-complexity, high-value work. They have consciously shed the low-margin stuff to focus exclusively on this.
So we've unpacked the pivot. We've looked at all the cool tech. Now we have to look at the investment verdict. This is the show me story, as the analysts call it.
That is the exact term they're using on Wall Street. Show me.
Because right now, today, the market is very skeptical.
The valuation tells the whole story. Amentum is currently trading at a forward price-to-earnings ratio, or PE, of about 12.2 times.
Okay, put that in context for us. Is 12.2 times good or bad?
Well, let's compare it to their direct peers. A company like Booz Allen Hamilton is trading around 15.5 times forward earnings. Leidos is also significantly higher. Amentum is trading at a clear discount. It's on sale, essentially.
Why? If they have space lasers and nuclear robots, why are they cheaper than their competitors?
Because the market hates complexity and uncertainty above all else. The merger with Jacobs was messy. The divestiture of Rapid Solutions makes the headline revenue look like it's shrinking. That negative cash flow glitch in Q1 scared a lot of people who didn't read the fine print.
So investors are saying, okay, you have a really cool story about the future, but show me the steady, reliable profits today.
That's exactly it. Show me the money. But if they do show them,
That's the whole opportunity.
that is the entire investment thesis. If Amentum can prove this merger works over the next few quarters, if they hit that debt reduction target, the stock should theoretically re-rate. That means the gap between that 12x multiple and the 15x multiple of its peers closes. And that closing of the gap is where the profit is for investors. You're betting that the market will eventually understand the story and value it correctly.
And they have a pretty big safety net while they try to prove it.
A massive one. The backlog.
$47.2 billion.
$47.2 billion in total backlog. That represents roughly 3.3 years of revenue coverage.
So let me get this straight. Even if the economy completely falls off a cliff tomorrow and they don't win a single new contract, they have enough work already signed up to keep them busy for the next 3 years.
Exactly. It gives them a tremendous amount of runway to get this transformation right. They aren't scrambling for new work. They're scrambling to execute the massive amount of work they've already won.
But we have to be fair here. We aren't cheerleaders for the company. What are the real risks? What could go wrong with this story?
Integration risk is number one, without a doubt. Merging two massive corporate cultures, the old Jacobs CMS and legacy Amentum, is incredibly difficult. Corporate history is just littered with failed mergers where the cultures clash, the best engineers quit, and the promised synergies never actually happened. If they don't realize those cost savings, they're going to miss their margin targets.
And what about seasonality?
The guidance for this fiscal year is back-end loaded, and that is always a scary phrase to hear from a CFO. They are promising a very strong ramp-up in revenue and profit in Q2, Q3, and Q4. If that ramp gets delayed, say a big project slips into 2027, they'll miss their year-end numbers and the stock will get punished. They've left themselves very little room for error in the second half of the year.
And of course, the big one, the reliance on the government.
Always. We saw it with the holiday cash flow issue. If the government shuts down for a month, or if defense budgets get cut in the next administration, Amentum feels it instantly. They are incredibly sensitive to the whims of Washington. You can be the best engineer in the world, but if Congress decides to close the checkbook, you don't get paid.
Okay, let's bring this all home. We've covered a lot of ground. We've covered this shrink-to-grow strategy, getting rid of the hardware business to focus on the brainware.
We talked about the second nuclear renaissance, how they're cleaning up the Cold War legacy at places like Sellafield and building the future with Rolls-Royce, all protected by that crucial international moat.
We talked about the space economy, how they're managing the airports of space for both the Space Force and for NASA's return to the moon.
And we covered the digital pivot selling outcomes and compute power as a service, not just hours in a chair.
So here's my final thought for you, the listener. Amentum looks, on paper, like a kind of boring government contractor. It's got a weird name. It's got a messy balance sheet right now. But under the hood, they are literally building the infrastructure for what might be the two biggest industrial shifts of our lifetime: the return of nuclear power and the economic colonization of space.
And that really raises the provocative question we should end on. If the second nuclear renaissance and the space economy are indeed the two biggest plays of the next decade, is the one company building the infrastructure for both trading at a discount simply because it's misunderstood? Or is the market right to wait and see if they can actually pull off this incredibly complex pivot?
That is the question. Are you buying the story or are you waiting for the proof?
Risk defined, portfolio protected.
And as always, we are just two people reading the reports. We are not financial advisors, so please do your own homework. But thanks for taking this deep dive with us into Amentum. We'll see you next time on Griffonomics.
See them.